Okay, Charandeep Singh and Varun Daga, founder of Girik Capital, they both join us to talk markets, and we'll also explicitly talk about this lovely column they've written on biases. All of us have biases in life, but in stock markets, what are the biases investors have? We'll talk about it. Gentlemen, good morning. Thank you for joining us. Oh my God, we all are matching. It's blue for Charandeep, blue for Varun, blue for me. We should be worried about the men in blue who are playing cricket today.
Yeah, unfortunately, that is not looking very good, the test match.
Yep. But what have we learned from the Australian cricket series? Don't give up hope, even if you don't have a good start. But markets this year, I'm saying markets this year are off to a great start. We saw a mid-air turbulence, bit of a stumble and fumble pre-budget, and now it's back to winning ways. What is your sense? Do you think the budget in a sense has unleashed the so-called phrase animal spirits and we are in a phase of massive earnings upgrade? Who wants to answer this very simple question? Varun, Charandeep, anybody?
I can take that. I'll tell you, it's very interesting because I think, we as investors at Girik, we don't really necessarily look at macro events as closely as many others do. But what we do is we try to follow a process. I mean, we've been following this process right through the COVID-19 virus pandemic, the whole crash that happened through that time. And, of course, earnings got wiped out. And, the shocking thing is that who would have thought sitting in January this year or February this year, who would have thought a year ago when the pandemic broke, we would cross the original estimate for Nifty earnings that we had for FY21. So people are talking about 500 rupees on the Nifty, which was unthinkable 3 or 4 months ago. So the budget may be good and all that. I mean, I hear very good things about it. It's fiscally very expensive. There are pros and cons to it. It's a very growth-oriented budget, which is a good thing. But I think the point I'm trying to make is that the earnings trajectory had already started moving up well before the budget. Maybe the budget does help certain out-of-favor sectors, certain infrastructure, industrial sectors. But what the market's been telling us and our systems and processes have been telling us for a long time now, that, that this bull market is well underway and it's been underway for a very long time, maybe since May or June. And we've only been hearing louder and louder skeptical voices. People were very pessimistic. People were willing to call tops as recently as, when the index hit 9,000, 10,000. And now, all of a sudden it's at 15,000. So it surprised everybody's expectations, both on the earnings front and on the price front.
Well, on a point which I was, in a sense, just exploring and debating, that 2014, when Prime Minister Modi got elected for the first time, we went through a change of perception. That changed the P multiple. But for the first time, is there a serious scope of a earnings upgrade? There is nothing better for a fundamental investor when the earnings upgrade start rather than P multiple, which is based on perception and perhaps flows.
Yeah, sure. I mean, I think, look, this is very hard to predict, right? Where PE multiples will go, whether they will go up, whether they will go down. I think, it's a question of sentiment. It's a question of money flows. Of course, earnings has a large part to do with it. But, the market tends to factor things well in advance. People must make note of that. It's, for all all the heightened expectations get factored in the next 6 months, and then you go into a possible long phase of consolidation. Who knows? So this is really a game about expectations versus, versus what actually happens. I don't think that, markets are very strange beasts. They tend to have a mind of their own. They may factor in things well in advance of what they actually happen.
Varun, when we spoke last, you were excited about IndiaMart. What a run-up it's been for IndiaMart. How do you value a stock like IndiaMart in this kind of an environment when the business is looking solid, but so are prices?
I think that's a great question, Nikunj, and good morning to all the viewers and to you too. And we're always glad to talk about IndiaMart. But I want to take you back to an example of the winner of the last bull market, Bajaj Finance. And I think something very similar happened with Bajaj Finance because it was, and again, we picked that early, but we sold it early. We thought we were very smart. We 5x'd our money and we sold it. And then we bought and sold again in the middle, but we could not ride the entire rally. And it was almost 100 bagger in that whole phase. So I think, learning from experience is that do not sell your winner too soon. Great companies have the ability to surprise you with earnings. And in the short run, many of these companies could look expensive. But when you look back 5 years later or 10 years later, probably, you would not find it as expensive as it seems today. So I think we are just following our process and trying to ride the winner as much as we can, and that's what we feel here because the opportunity size is huge. The delivery on the earnings are greater than expectations, and we really think that they're on a very very strong footing, and the industry tailwind is with them. So we keep our eyes open and we try to follow a process. If something goes wrong, we will keep a track on the fundamentals and on the price.
Sandeep, I go back to a point which we've discussed again, but this point needs perhaps a revisit again and again because right now markets are going through this process that buy stocks which are cheap, that word value seems to be making a comeback. Your holdings are not based around P multiple, they are based on what Varun said. What is growing, buy it. If the runway is strong, in hindsight, we will look back and said that, look, that was a high growth company. But I'm intrigued to understand that why do you still have a stock like Cipla in your portfolio? Because this is not like the IndiaMart or the Jubilant Foodwork or L&T Infotech which you own.
Well, we hope it becomes, no? I think the whole process is centered around finding those kind of winners that give you... See, we are portfolio managers. We have to build a portfolio. And in that portfolio, you're hoping for the best outcome, process-driven, systematic, both fundamentally and price-oriented with every one of your stocks. You want all of them to end up the same way, right? Ideally. You're not going to get every single one of them right. You're not going to get outsized winners like an IndiaMart or a Dixon or a Tata Elxsi every day, right? Follow the process with all of them, and some of them work out much better than the others. Of course, the winners will always get highlighted. Cipla has for us been an average winner. It's been an underperformer, but it's been okay. There are, of course, duds as well, which you will not see, which we get rid of, which we take proactive action, and our process tells us that, look, something's not doing well in a good market. Please revisit the fundamentals, make sure the capital is well allocated, and make sure you make money for your investors. That's the bottom line. So I hope that answers your question, Nikunj.
Varun, we spoke about Bajaj Finance, but we spoke about Bajaj Finance as an example where a stock has given you extraordinary returns, and it's difficult to find stocks like Bajaj Finance because it's a rare breed. It's a rare breed to find a stock like Bajaj Finance, Indigo, Bajaj Finance, DMart, HDFC Bank. They're a rarity to get in any decade. But if you, let's say, have to
IndiaMart, we didn't know that it's going to be such a big winner. So it's very difficult to say on day one that this is where you're going to get outsized winners. What you have to do is, again, we go back to the same thing. You have to put up a process which has the ability to throw up great winners and throw up the opportunities that can create great winners. So I think what's more important is that everybody in their portfolio would buy a winner at some point. Take an example of a Titan. I'm sure all of us at some point in time bought Titan in the last 2 decades, but there's only one guy who held it for the entire 20 years and made enormous wealth. So I feel that again, it's a process of riding winners. Uh, you could have losers in your portfolio. You will have losers in your portfolio. You will have winners in your portfolio, and some of them will become large winners. The idea is that can you get over your biases? Can you get over your fears of that temptation to book a profit too early? So I think if one follows that process, there have been so many winners in the past decade. Apart from the names you mentioned, there'll be many more, and there will be many more. The idea is, do you have the framework? Do you have the emotions? Do you have the ability to hold on to them as they grow in wealth and as they make profits for you? Because it's very, very hard. It's probably one of the hardest thing to hold on to your winner, because you're always fearing, will I lose the profits which I made? So I think it's first to get over your own fears, and then I'm sure many multi-baggers will come in your portfolio and you'll be able to hold it.
So, Charandeep, let's talk about biases. Varun has given me a prompt to now move to the second part of our interaction, which is biases. In your article, you're making an important point that we all suffer with what is called as confirmatory bias. Can I use this example against you and say that, look, you are a bull and perhaps you're looking at confirmatory bias signals by only looking at good things and not the bad things? How does this work?
I'll tell you what it is, I'll take a step back. I want to make one quotation which I think is going to be value added for all your viewers first, and then I will answer your question. So I'm not avoiding your question. A lot of people this is from Charlie Munger, right? And this is an inspiration. He says a lot of people with high IQs are terrible investors because they've got terrible temperaments. You need to keep raw, irrational emotion under control. So I think this is what really was the driving force for writing this article. Something that is which is a subject very close to our heart. Human beings tend to make really stupid decisions with their investments, and we would like that they do not. And they are process oriented and systematic. Now, coming to your question about, are we falling for that trap? I think not, because, I'll tell you, the very ethos of Girik is to be process oriented and system oriented. So when we build our portfolio, we have a process which is system driven, which throws out which are the best performing sectors and which are the best performing stocks within those sectors. And that is where we allocate capital. We do all our fundamental research only within those sectors. We do not look outside, right? So as long as we have a combination of price, strength and fundamentals, we will buy and we will continue to hold. The second part of our framework and process, which is again what we mentioned in the article, to overcome these biases, make sure your process works, build awareness that you are following a process, build awareness that you are not falling trap to the regular chatter in the market, or should I take profits before a budget? The budget could be bad, or before election I may sell, BJP might lose. These things ignored, please. They make no difference in the long term, I promise you. So the second part of our process, I was saying, was taking losses. When you are wrong, are you brave enough to identify it and say, look, I bought Bharti or I bought Reliance, I invested a lot of capital into telecom, but it didn't really work out for me within the time frame that I desired. Something went wrong. Do I have the framework to downsize my position and make sure my capital is allocated in the best place? So I think there are two elements to our process here. So I think the confirmation bias part is taken care of by good quality risk management systems. You have to have that run separately and parallelly. And then you can say that you can fight these biases.
Okay. Varun, another very important bias is recency bias, and that is where I think a lot of fundamental investors, they get trapped. US-based big tech has worked well, which means it will continue to do well. Of late, pharma and IT have done well, that means they'll continue to outperform. Of late, mega caps have done well, don't buy small caps. How would you avoid recency bias in your portfolio? Because some would argue that in your portfolio, you are tilted towards tech. And maybe that is an indication that a tech trade has worked, so you're buying tech stocks?
Yeah. No, that's a great question, and I think recency bias is a very, very relevant bias, and a lot of people don't even understand this bias because you're so used to what's happened in the recent past, whether it's a crash or a rise, that you completely miss that it is actually a bias and it's one of your emotions. So, like we saw the recent fall in the market, and after that, nobody could catch the rise because they were so scared of the next fall, and everybody thought that there will be another correction and we'll go back to the same levels, and everybody missed one of the, and most of the people missed one of the biggest rally in the recent probably a decade. You're absolutely right. You know, we fall trapped in these recency biases. A lot of our investors have called us recently that do you invest in the U.S. markets just because U.S. markets are doing well? Do you have a process that you should look at U.S. markets and this and that? So so it's again recency bias. So the idea for us is we got to be aware that these are biases, and we got to overcome these biases through process. What Charandeep talked about is that we could have some of these stocks in our portfolio which were winners of the past. Like Reliance is a great example. Like we made money in Reliance, but and it became a large part of our portfolio. But once it showed signs that it was not doing as well as we expected, we started trimming it. In spite of us coming on TV and talking such highly of Reliance, and it might actually happen. But when we are managing public money, we got to come over our own emotions. Our process needs to supersede our own biases. So I could be having a confirmation bias. Oh, how can we trim Reliance? We went on TV and said there is going to be such a large company. But the idea is when the process tells us that you have to trim it, you have to trim it. So we got to you have to have processes, Nikunj, to make sure that you do not fall yourself in some of these biases traps. And recency bias is one of the biggest trap which we feel investors fall into.
Sanjeev, before I wrap, I'm just using another portfolio stock of yours for illustrative purposes, Tata Elxsi. It's a stock which has given absolutely phenomenal returns, and not from the recent low. Even last 3 years before the pandemic and post-pandemic, you got to bite your fingers to see what kind of return a technology company, which is a 20-year-old company, has suddenly given. How would this entire theory of recency bias not fit in there? Because if you're buying it now, it means that you think it's a long way to go. But this is one trade which has worked in the past. How would you avoid that temptation with a stock like Tata Elxsi?
So again, I think the recency bias needs to be well understood. You see, when we take a decision to enter a stock, right, it shows up on our screeners. Once it shows up on our screeners, we do the fundamental work, and we have to have clarity about the earnings tailwind and the leadership of the business. When we have that, we size our position accordingly based on liquidity, based on how much exposure we have to the overall industry. So say, for example, if you are in IT services, we won't cross a certain percentage overall. I think a lot of your processes are taken care of there. If you look at the overall index, we talked about index investing. What the index does very well is that it allocates capital very well. It says, I will not cross a certain percentage within a certain sector. We do the same. We try to make sure that we are not carried away. We may love the earnings tailwind because of cloud computing, because of outsourced R&D, etc., over the next decade or so. But irrespective, it's not 10% of our portfolio. You start with a maybe 3 to 4% allocation to your portfolio. It's a smallish company. It wasn't a big company when we bought it. It's moved up very quickly, of course. But I think that the important aspect is, like we've been talking about all through process, framework, controlling positions, controlling sizing accordingly. And yes, when the tide turns and when you are, if your thesis isn't working out, to have the awareness and process that, yes, you need to take action otherwise.
Oh, fair point, gentlemen. Good to have you on ET Now again. Thank you for joining us. And certainly hope to see much more of you going forward, and I look forward to your next article. The first one, which the one before which I read on P, was an indication on valuations, and the latest one, which is there on our website and again on our Twitter plate, is about biases. I would encourage all our viewers and readers to really read that article. It talks brilliantly about the challenges and the biases which as investors we all suffer with.